The global financial system has long operated as a highly structured machine, running on a set of universally understood rules. For decades, regulators tracked financial crime using a specific vocabulary. They looked for centralized banks to hold funds, registered shell companies to hide ownership, and standard wire transfers to move value across borders. When value moved outside these institutional checkpoints, it usually took the form of physical cash. The yellow currency straps and bound stacks shown here representing the ultimate untraceable bearer asset. As long as money remained within these physical and institutional frameworks, compliance officers knew how to identify criminal behavior and initiate legal enforcement. Decentralized finance dismantled that physical perimeter. Today, billions of dollars move across borders instantly, peer-to-peer, without the oversight of a central banking authority. Crimes like fraud and money laundering persist in this new environment, but the operational vocabulary used to track them has splintered. To maintain oversight, compliance officers must now map old-world banking concepts directly onto on-chain mechanics. Consider custody. A traditional bank functions as a regulated gateway, much like a virtual asset service provider, or VASP. These are entities like digital exchanges that hold user funds and verify identities. However, Web3 also introduced a digital equivalent to physical cash that operates outside of this regulated gateway. This is the unhosted wallet. It allows a user exclusive custody of their cryptographic keys, removing third-party oversight. When the key detaches from the standard network, it creates a compliance blind spot. This self-custodial architecture bypasses institutional Know Your Customer frameworks. Beyond custody, we have to look at how data moves. In legacy finance, wire transfers carry detailed information about the sender and receiver. Blockchain transactions require a similar layer of transparency. The Financial Action Task Force, pictured here, manages this through Recommendation 16, the Travel Rule. It mandates that digital asset providers securely transmit identity data of both the sender and receiver for transactions exceeding a set threshold. But international compliance often hits a wall known as the sunrise issue. This occurs when one country enforces the travel rule, but the counterparty's jurisdiction has not yet passed the law. Without universal adoption of these rules, funds can become trapped in a state of regulatory limbo, unable to move between compliant and non-compliant zones. Evasion tactics have also adapted. In the old system, money laundering often involved layering funds through shell companies. In Web3, this takes a high-speed digital form. This is a peeling chain. A massive deposit is stripped across dozens of addresses, spinning off smaller amounts at each hop. Scanners can't keep up with hop-on velocity. Criminals move funds out of addresses in under 4 seconds, outrunning automated compliance flags. By utilizing structural automation, criminals use speed as a shield, attempting to outpace the batch processing systems used by many institutions. Even the nature of the bank heist has changed. What used to be a physical breach or internal fraud has evolved into a structural exploit of a protocol's code. Attackers don't always need to break through a firewall. Often they simply manipulate economic design flaws within a smart contract. A flash loan exploit follows this pattern. A criminal borrows millions in assets instantly to artificially distort a token's price on an automated market maker. This massive capital block tricks the system's external data feed, allowing the attacker to drain the protocol and repay the loan all within a single transaction block. Because the code worked exactly as written, this requires a shift in security. Compliance teams must look past traditional firewalls and monitor the economic logic of the contracts themselves. While these risks are significant, the blockchain provides a unique advantage. It is a fully transparent and permanent ledger. This transparency has shifted the focus of the compliance industry. Instead of checking static user IDs, investigators now monitor the real-time behavioral flow of funds. We call this KYT, Know Your Transaction. By analyzing behavioral patterns, forensic tools create explicit connections between high-risk wallets that were once thought to be anonymous. These platforms use glass box attribution to detail exactly why an address was flagged, stripping away the illusion of secrecy node by node. Ultimately, managing digital asset risk doesn't mean starting from scratch. It means applying the core principles of financial safety to the specific, high-speed mechanics of the blockchain.